Welcome to The Explainer. Today, we're taking the incredibly dense financial data of NLY Capital Management's latest quarter and translating it into clear, actionable insights. Look, if you follow the real estate investment trust space, you already know NLY is a massive player. But the actual mechanics behind how they're navigating today's really tricky economic waters, it's fascinating. And we're going to break the whole thing down for you right now.
To really wrap our heads around the sheer scale of what we're looking at, let's just start with their total portfolio size. $109.4 billion. I mean, that's not just a portfolio, right? That is a formidable economic engine. Managing that amount of capital, especially when interest rates are this unpredictable, requires some absolute precision and a highly calculated strategy.
So, here's our roadmap for today. We'll start with the Q2 2026 headlines, then navigate the macroeconomy, take a look inside that $109 billion portfolio, do a deep dive strategy breakdown, and finish up with their long-term track record.
All right, let's kick things off with Section 1, the Q2 2026 headlines.
Let's look at the top-line numbers that really define their second quarter, because the standout figures here are incredibly strong. They posted earnings available for distribution, or EAD, of 79 cents per average common share. They maintained a book value of $20.15 and distributed a cash dividend of 75 cents per share. Now here is the crucial takeaway. Their earnings available for distribution actually outperformed their dividend. This highlights some incredibly durable earnings power. They aren't just paying out a dividend, they are very comfortably earning it.
And that brings their dividend yield for the quarter to 13.4%. Yeah, you heard that right. In a market where we're all constantly hunting for reliable yield, a double-digit figure like this, especially one that's fully covered by core earnings, is just a fantastic number for any yield-focused investor.
Moving right along to Section 2, navigating the macro economy. To truly grasp how impressive those Q2 results are, we have to look at the battlefield they're operating on, because no financial portfolio exists in a vacuum. We are currently watching a massive macroeconomic tug of war. On one side of the rope, we have firm, stubborn inflation. This actually re-accelerated in 2026, driven mostly by geopolitical risks in the Middle East and the sheer amount of capital being poured into AI infrastructure. But on the other side of the rope, we have a surprisingly stable labor market, with 3-month average hiring hitting levels we literally haven't seen since late 2024. So this tug of war has basically forced the Federal Reserve to maintain or even modestly increase rates just to fight off those price pressures.
So what does this actually mean for the market? Well, the repricing of Fed policy, meaning the market baked in about 38 basis points of expected hikes for 2026, led directly to higher short-term yields. And the ultimate outcome of that was a flattened yield curve. Now, this environment of rising short-term yields and a flat curve makes mortgage investing extremely tricky because it typically squeezes profit margins tight. But despite these headwinds, market volatility actually remains surprisingly muted as those geopolitical risk premiums faded toward the end of the quarter.
Okay, Section 3, inside that $109 billion portfolio.
So how does NLY actually survive, let alone thrive, in this flattened yield curve environment? The secret sauce is their highly deliberate structure. They use a diversified platform that acts exactly like a three-legged stool. This isn't just about throwing different assets at the wall to see what sticks. It's a meticulously designed mechanism that shields the portfolio against market volatility while simultaneously acting as an engine for steady, levered returns. Basically, when one sector faces pressure, the others step up and provide the balance.
You can see that balance perfectly right here. They spread their capital across 3 complementary sectors. You've got 57% of their capital allocated to agency mortgage-backed securities, 22% dedicated to residential credit, and the remaining 21% goes to MSR, or mortgage servicing rights. Which brings us perfectly to Section 4, a deep dive into that strategy breakdown.
Let's look at the biggest leg of that stool first, the agency MBS portfolio. This leg represents a towering $95 billion. And they weren't just sitting on their hands during Q2. They proactively deployed incremental capital into higher-yielding coupons, specifically 5.0% and higher. By actively shifting those investments, they successfully pushed the portfolio's weighted average coupon up to 5.11%. That's a strategic move that generates much better carry and really helps protect the portfolio if rates decide to move again.
Leg number 2 is the residential credit portfolio, which holds $10.4 billion in assets. NLY is an absolute powerhouse in this space. They actually rank as the largest non-bank issuer of prime jumbo and expanded credit MBS. And man, they had an incredibly busy first half of 2026. They priced 25 residential whole loan securitizations totaling a staggering $14.2 billion.
Before we hit the third leg, let's do a quick jargon check. MSR, or Mortgage Servicing Rights. Just as a reminder, this relies on the contractual obligation to service residential loans. So we're talking about collecting the monthly payments, managing the escrow accounts, handling customer service, all in exchange for a fixed servicing fee.
So why does this matter? Well, holding these MSRs, which are currently valued at $4.1 billion, becomes highly profitable in today's environment. Think about it. Because interest rates are so high right now, homeowners are absolutely not rushing out to refinance their homes. That means prepayment speeds are incredibly low, which ensures NLY gets a nice steady stream of servicing fees. On top of that, holding those escrow balances produces high float income when short-term interest rates are up. This leg of the stool alone makes NLY a top 10 agency MBS servicer.
Of course, supporting all three of these incredibly complex strategies is a bedrock of financial discipline. I mean, you can't run a $109 billion portfolio without it. They maintain highly disciplined leverage, which actually dropped slightly to 5.6 times this quarter, and they possess ample liquidity. They boast $9.6 billion of total assets available for financing, and that includes $5.5 billion in cash and unencumbered agency MBS. So yeah, that is a very, very sturdy safety net.
Finally, let's look at Section 5, the long-term track record.
We've unpacked a great quarter, but true financial resilience is measured in years, right? Well, this right here is the ultimate mic drop. Since scaling their residential credit and MSR businesses and exiting their non-core strategies at the end of 2022, NLY has delivered a massive 37% cumulative economic return. When you compare that to the MRI peer average of just 25%, it is obvious that their diversified, three-legged platform is crushing it. And this proves Q2 wasn't just some lucky break. Their diversified strategy has delivered consistent, positive economic returns in 12 of the last 13 quarters. That means they are winning 92% of the time. Contrast that with the peer average, which is only positive 65% of the time, and the power of this balanced approach just speaks for itself. Which brings us to our final takeaway today. As you think about sticky inflation, geopolitical risks, and the Fed's rate hikes, I want you to consider the architecture of your own investments. Is your portfolio built with a three-legged stool for ultimate resilience? Consider how NLY's diversified mechanics, expertly balancing agency securities, residential credit, and mortgage servicing rights might inspire your own approach to weathering financial storms. Thanks so much for joining this explainer, and keep learning.